Greenwich, Connecticut, May 5th, 1999, 7:43 in the morning. Neighbors on Lake Avenue notice something unusual about the 50-room mansion at the end of the street. It is on fire, not the small accidental fire of a kitchen left unattended. The kind of fire that is started deliberately, in multiple rooms, at multiple points, by a person who needs everything inside that building destroyed before anyone else can see it. By the time fire investigators walk through the ashes, they find shredded documents, melted hard drives, empty safe compartments that were clearly cleared in a hurry, and a to-do list, written in the owner's own handwriting, left behind in the panic of a man running for his life. Item 1 on the list: launder money through Vatican. Item 2, get fake passport. Item 3, buy more diamonds. The man who wrote that list is already gone. He has left behind $208 million stolen from insurance policyholders across 7 American states. He has left behind 17 women who lived with him in that mansion. He has left behind a fake Vatican charity he invented to move stolen money through the Catholic Church. He has left behind astrologers he paid $60,000 a year to help him predict stock movements. And he has left behind the single most important fact about this entire story. Martin Frankel was barred from the American securities industry in 1992. Every single state that gave him a license to manage insurance company reserves after that date simply did not check. 7 states, $208 million, 0 background checks. This is the story of the most audacious financial fraud you have never heard of. And the question is not how Martin Frankel stole $208 million from ordinary Americans who paid their insurance premiums their whole lives. The question is how the system that was supposed to stop him waved him through 7 times in a row. To understand how Martin Frankel convinced 7 state insurance regulators to trust him with other people's money, you have to understand what Martin Frankel actually was. He was not a financial genius. He was not a ruthless professional criminal. He was a man who had been terrified of failure his entire life, who had never held a job for more than a few months, who believed deeply in astrology, and who had been formally found by his own psychiatric evaluators to suffer from a severe phobia of making financial decisions. Let that sit for a moment. The man who would go on to manage $208 million in insurance policyholder reserves had been clinically assessed as having a phobia of making financial decisions. He grew up in Sylvania, Ohio, moderately comfortable family. His father worked in the family business. Martin was considered bright but unfocused. He attended the University of Toledo. He dropped out. He tried to become a stockbroker in the 1980s. He passed his licensing exam on the 2nd attempt. He was immediately fired from his first firm for being unable to make trades. The paralysis was total. A client would call and ask him to execute a buy order, and Martin Frankel would simply not be able to do it. He would put the phone down and stare at the screen and not press the button. He was referred to a psychiatrist. The diagnosis was extreme anxiety disorder, combined with what the evaluating physician described as a pathological fear of being wrong. This is the man who was about to steal $208 million and almost get away with it, because Martin Frankel understood something about the financial system that very few people ever figure out. The people who are supposed to check your credentials almost never actually check your credentials. Before Martin Frankel can steal anything, he needs access to something called policyholder reserves. When you pay a monthly premium on a life insurance policy, that money does not sit in a vault with your name on it. It goes into a pool. a reserve fund managed by the insurance company's investment manager. The reserve earns returns. Those returns allow the company to pay out claims when policyholders die. The people who manage these reserves are supposed to be licensed, regulated, and thoroughly vetted. Their investment decisions directly affect whether ordinary policyholders actually receive what they paid for their entire lives. State insurance regulators are the gatekeepers of this system. Before any investment manager can touch policyholder reserves, that manager must be approved by the state's insurance department. The approval process is designed to be rigorous. Background checks, financial history reviews, licensing verification. The assumption built into the entire system is that if a person has been barred from the securities industry by federal regulators, the state insurance departments will know about it and act on it. The assumption is wrong. In 1992, the National Association of Securities Dealers, the federal body that regulates stockbrokers, permanently bars Martin Frankel from the American securities industry. The reason: failure to supervise client accounts, failure to execute trades, conduct inconsistent with professional standards. This bar is public record. It is filed in the federal system. It is available to any regulator in the country who looks for it. 7 state insurance departments will approve Martin Frankel to manage policyholder reserves without ever looking for it. Frankel's plan is simple, audacious, and almost elegant in its exploitation of bureaucratic blindness. He cannot work in securities, but he has noticed that small insurance companies in rural American states often have very limited investment management capacity. Their reserves are small. Their regulatory oversight is minimal. Their state insurance departments are under-resourced and overwhelmed. If he can buy one of these small companies, he becomes the investment manager by default. He does not need a license to manage the reserves of a company he owns. He does not need to pass any additional federal scrutiny. He just needs to convince a state insurance regulator that he is a legitimate buyer with legitimate funds. In 1991, using money borrowed from a wealthy businessman named John Hackney, who genuinely believes Frankel is a financial genius, Frankel buys his first small insurance company, a tiny operation in Tennessee called Franklin American Life Insurance. He is now the investment manager of Franklin American Life's policyholder reserves. He immediately begins moving those reserves into accounts he controls personally. The first theft, small, cautious, completely undetected. And Frankel realizes something that will drive the next 8 years of the most audacious financial fraud in American insurance history. Nobody is watching. Over the next 8 years, Martin Frankel buys insurance companies the way other people buy lottery tickets. One at a time, in different states. Each one slightly bigger than the last. Mississippi, Missouri, Arkansas, Oklahoma, Tennessee, Virginia, Georgia, 7 states. Each one approving him as a legitimate buyer. Each one failing to check the federal bar from 1992. Each one handing him access to the life savings of thousands of ordinary American policyholders. The method is consistent across every acquisition. He presents fabricated financial statements showing Thuner Trust, his fake investment management entity, based in the British Virgin Islands, as a sophisticated and enormously successful fund. The statements show consistent returns. The statements show massive assets under management. The statements are completely invented. He provides reference letters from other financial institutions. Most of the reference letters are written by members of his own household staff and signed with invented names. He answers any difficult question with a simple response. His investment strategy is proprietary. His fund structure is confidential for competitive reasons. Any regulator who demands more specific information is welcome to decline his application. No regulator ever declines. At its peak, Martin Frankel controls the reserves of 9 insurance companies across 7 states, managing the policyholder funds of tens of thousands of ordinary Americans who have no idea their premium payments are sitting in accounts controlled by a man living in a 50-room mansion in Greenwich, Connecticut, with 17 women and a team of astrologers. The mansion is real. The astrologers are real. The 17 women are real. The investment management is not. The house on Lake Avenue in Greenwich is purchased in 1991 using insurance company reserves. It costs $9 million. Frankel renames it Frankel Compound. Over the next 8 years, it expands to encompass the original building plus multiple additional structures, a security perimeter, a full-time household staff, and a network of surveillance cameras covering every approach. Inside, 17 women, some of them romantic partners, some of them employees, some of them both. None of them fully aware of what all the others are, or what Frankel is doing with the money that funds their lives. The astrologers are given an office in the mansion. Their specific task is to advise Frankel on investment timing using astrological charts. He pays them $60,000 annually. He does not make a significant financial decision without their input. He believes completely in their guidance. There is a trading room set up with professional financial terminals, Bloomberg screens, market data feeds, everything a serious investment manager would need. The screens are almost never used for actual trading. Frankel sits in the trading room and watches the markets the way a person watches a movie. He does not trade. He cannot trade. The phobia that ended his stockbroking career in 1985 is still there in 1999. He manages $208 million in policyholder reserves, and he cannot make himself execute a trade. Instead, he moves the money from insurance company reserve accounts into his personal accounts, then from personal accounts into offshore vehicles, then into diamonds. Diamonds are portable. Diamonds are untraceable. Diamonds do not require him to make a trade. The diamond collection grows through the 1990s until it is worth an estimated $10 million, hidden in the mansion. In a panic room he has had built specifically to hide them. In 1998, Martin Frankel has a problem. The insurance companies he has been systematically draining are running low on reserves. Some of them are approaching insolvency. State regulators are beginning to ask questions that are harder to deflect with proprietary strategy explanations. He needs new capital, enormous new capital, fast. His solution: he decides to launder stolen insurance money through the Vatican, not through a Vatican official, not through a Vatican bank, through a completely fabricated Vatican-affiliated charity that he invents himself. He names it the St. Francis of Assisi Foundation. He hires a Catholic priest, Father Peter Jacobs, a genuine ordained priest who is either deceived or desperately motivated to serve as the foundation's representative. He approaches Vatican officials with a proposal: allow the St. Francis of Assisi Foundation to operate under Vatican endorsement, and the foundation will invest in American insurance companies for the benefit of the Catholic Church. Several Vatican officials take preliminary meetings. The Vatican ultimately does not endorse the scheme. But the attempt is real. The meetings are real. And Martin Frankel spends an estimated $3 million of stolen policyholder money traveling to Rome, hosting Vatican officials, and attempting to use the moral authority of the Catholic Church to launder funds stolen from the people who paid their life insurance premiums every month for 30 years. May 4th, 1999. Tennessee insurance regulators make a routine inquiry about the reserve levels of one of Frankel's companies. The inquiry is slightly more specific than previous ones, more specific than Frankel can deflect with his usual proprietary strategy response. He realizes what is coming. That night, he begins to burn the mansion. He moves through multiple rooms, starting fires. He empties the panic room. He takes the diamond collection, $10 million in diamonds, in a bag. He gathers his fake passports. He leaves his to-do list on the kitchen counter. He does not mean to leave the to-do list. By the time investigators arrive, the mansion is burning. Frankel is gone, and his to-do list, handwritten, specific, and complete, is sitting on the kitchen counter in the only room where the fire did not reach. The list includes: contact Vatican about foundation status, move diamonds to Europe, acquire additional passports, arrange wire transfer through offshore vehicle. The FBI issues an international arrest warrant. Frankel flies to Rome, then to Germany. He is arrested in Hamburg on September 9th, 1999, living under the name Eric David, with 2 women, $600,000 in cash and diamonds, and 17 fake passports. He does not resist arrest. The 2 women tell investigators they had no idea who he was. The total stolen from 9 insurance companies across 7 states. $208 million. The people who lost the most were not hedge funds. They were not sophisticated investors who made a calculated risk. They were ordinary Americans who paid their life insurance premiums every month for decades because they wanted to make sure their families would be protected when they died. Several of the insurance companies Frankel drained became insolvent and were taken over by state guarantee funds. Policyholders in some states received less than the full value of their policies. People who had paid premiums their entire working lives received partial payouts. Frankel was extradited to the United States in 2000. He pleaded guilty to 51 counts of racketeering, fraud, and conspiracy in 2002. He was sentenced to 16 years and 8 months in federal prison. John Hackney, the businessman who lent Frankel his initial credibility and early capital, received 6 years. Father Peter Jacobs, the priest who represented the fake Vatican charity, was sentenced to 18 months. The 7 state insurance departments that approved Frankel without checking the federal securities bar were never charged with anything. The system that failed tens of thousands of ordinary policyholders was given minor procedural reforms and continued operating. Martin Frankel stole $208 million from ordinary American policyholders, attempted to launder it through the Vatican, fled with $10 million in diamonds, and was caught in Hamburg with 17 fake passports. And almost nobody knows his name. The reason is not complicated. His victims were not glamorous. They were not Wall Street banks or sophisticated investors. They were the kind of people who pay their insurance premiums every month and trust that the system watching over that money is doing its job. When the system fails ordinary people quietly, the story rarely breaks through to the level of a national scandal. $208 million, 7 states, 0 background checks. One man with a phobia of making financial decisions who understood that the people paid to stop him almost never actually do their jobs. This is what this channel exists to do. Every video on Boome is a story exactly like this one. A financial crime that shaped real lives, destroyed real families, and was almost completely forgotten because the victims were not famous enough to demand more attention. The algorithm will not always show you these stories, but if you subscribe to this channel right now, you will never miss one. Every week, we go deeper into the financial crimes that history buried. Hit the subscribe button, and we will see you in the next one.